diba, like I said, a plumber would have a toolkit, diba? Or maybe a doctor would have its medical bag with him whenever he goes. And these are certain gadgets that, you know, that certain craft or profession would need, correct? In order to address whatever problem, let's say, that a plumber has to address, or a doctor in checking a patient, right? Now, you as business people, especially if you do want to venture into the track or specialization of finance, this is a toolkit that you need to have. But even if you're not a finance major, this is just for entry and business people to know. Okay? What do I do in order to analyze the company's financial statements? Anyway, the third part of the toolkit are financial ratios. This is something that is not new to you, right? You have been doing this since last semester after each chapter, if you remember. Yes? So, if we were to segment or segregate the financial ratios into groups, we can say that we can come up in our book with 3 groups. And the first group of ratios would measure liquidity, right? The second group would measure profitability, and the third, solvency. These, I think, at least these two, I'm pretty sure, are very familiar words na to you, or terms, right? Liquidity addresses the ability to meet current obligations when they fall due using their own current assets. What does that mean? What are the current liabilities that a company normally has? Amounts payable, taxes payable, salaries payable. So do you see, you know, these are the recurring, normal, day-to-day operational liabilities, right? Okay. As they fall due, they can be satisfied. We'd like that assurance that a company can answer for its obligations, correct? By checking liquidity. So, current asset needs to be matched with current liabilities, which are the current obligations, right? That's liquidity for you. Profitability measures how well they did when they tried selling services or goods. You know, what were the matching expenses to make this sale happen? And at the end of the day, were they successful in posting a positive profit or a difference between revenues and expenses, right? Alright. And it actually also is an indication of the operating efficiency of a company. Because if they make revenues now, but their expenses are just too high, meaning they're not really efficient, diba? They're overspending on a lot of things, then the tendency is profitability to be non-existent. So it will be unprofitability, right? Meaning net loss. The third might be, is this the first time we're encountering solvency? Or not quite? I think we've encountered it now. Okay. Solvency is like liquidity. The only difference is it is long term. So it is the ability for a company to meet obligations, true, be able to pay obligations. But these obligations are long-term in nature. As opposed to liquidity, the obligations are current and short-term. Okay? So, measures short-term ability, measures income and operating success, right? And this one is, you know, mostly in the income statement, measures the ability to survive over a long period of time. And all of a sudden, sustainability is in question here. See it? Because we're looking at long term all of a sudden. So, as I've mentioned to you once before, your grade, if it is just you here in the school, has really no meaning, even if you got a 1, if you're the only student here. Okay? So it's like a ratio. Single ratio makes no sense. We do not get to compare it with another. Whether another ratio from the same company at another time, meaning, what is that term again? If you're comparing yourself with yourself. Oh, kaya niyan. Intracell. Intra-company. Intra means internal, right? And inter-company means with another company. Maybe, possibly, or more often than not, a competitor. Correct? Industry is that average for that group of companies that work towards the same line of business. Okay. So let's look at liquidity ratios. And this, like I said, have been discussed before. It is just a reiteration. What I plan to do is just go through first all the ratios, okay? Okay, as much as I can. And then maybe tomorrow we'll do a lot of practicing so that you're all set for Tuesday. Okay? Current ratio. Does this sound familiar? Does this ring a bell? We've encountered this before. Acid test, maybe, maybe not. AR turnover. Inventory turnover. Familiar, very familiar. These are all under liquidity. Okay? So, let's do one. Current ratio just picks up current assets, the total, divided by current liabilities. Okay? So, in quality's case, we pick up what is the current asset? 10, 20, 1 million and 20 divided by?
344.
Well, I go 344. Fine. Right? We get current assets divided by current liabilities, right? And therefore, it is 2.96. 2.96 is to 1. Meaning that for every almost $3, right? For almost every $3 of current asset is $1 of current liability. So parang there's enough coverage. Correct? So we're kind of happy with this one. 2:1, maybe okay, so-so. But 3:1 is even better. What we don't want to see is like 10:1 because they're putting too much current assets and not putting it somewhere else like an investment. Diba? That's also inefficient. If we were to look at quality, in 2013, it was 2.96:1. Intra-company, they were better off a year ago. Okay? You remember why? You remember the story of quality? They had to expand and they used some of their cash. Hence, cash went down. And that explains, this further validates that, right? That story. Ang ganda ng memory ni Siana today. Oh, did you eat kanina? Corned beef. That's corned beef talaga is a champion. If I look at industry average, the whole industry is doing, when you average all the different companies within that same line of work, $1.70 is to 1. So, hey, not too bad for a small department store in Middletown, America, right? And then, competitor also called us but that method in intercompany, we're really better off than Macy's. Macy's is 1.52 is to 1, right? So, that's that. And then we go to the next liquidity ratio called acid test. Acid test. Sometimes it's also called quick ratio. Okay? Same meaning. This is basically kind of like current ratio, but one important current asset is taken out, and that is inventory. Okay? So, and sometimes they exclude prepaid expenses because it's very minor. So if this is the set of current assets the company has, okay, they will check of cash, short-term investment, and AR. They will exclude inventory, and sometimes they will exclude prepaid expenses as well. Some would say will include this, but this, you know, is kind of small in relation to like this. Okay. So let me ask you lang first. What again is the nature of the company's business? They're retail, right? And retail or department stores like that are heavy on inventory. Do you agree?
Yes.
I mean, that is the lifeblood of their business. Without it, they are nothing. That kind of defines them. So if you take away inventory altogether, it will go really down as far as current assets are concerned, right? So, okay. So here is the formula for quick ratio. You get all current assets excluding inventory and prepaid, right? So in our case, what do you think are the numbers for quality? See, it's 100,000 plus, which total how much? 350 ba? Tama ba? So, this 3, right? 350, and then our denominator is still the same. Very good. And you will now get 1.02. All of a sudden, without inventory, it's almost 1:1. For every dollar of current assets without inventory, same matched obligation because the bulk of their is inventory. But it is unfair to make a judgment out of quick ratio for a company whose lifeblood is inventory. Okay? So let's not put too much weight on that. Now, if you go to, if let's say this falls way below 1.02, like 0.50 cents of assets is to 1, then that, you know, that's too could be nerve-wracking because that means they have invested too much on inventory, and inventory is subject to obsolescence, right? What do they say in the fashion world? One day you're in, next day you're out. What if your merchandise is on the fashion side of things? What if it is outdated in say a few months? Is that of the same value still? So that's worrisome, right? So, you know, the quality of inventory or other inventories outside of say a department store setting could be subject to spoilage. Can that happen? Say if it's perishable, if it's food, or if it has a shelf life or an expiration date, right? Or if it is subject to, say, a lot of pilferage, wherein you don't provide enough security. Let's say that your inventory is gold, or you're a jeweler and your inventory is diamonds. Think about that. So it's very sensitive. That's why inventory is given a lot of weight in the analysis, right? Yeah, I just noticed, no? What happened to everybody? They don't like they don't like us anymore, no?
Yes, I said like, I mean, like this.
Okay. But they don't like us anymore, no? Paano yun? Like, it's okay. And this is easy anyway. So, How do they fare? With themselves, it's still a downgrade from last year. You see it? With industry, wait a minute. Looks like it's not too bad, 1:1. Because industry says 70 cents to $1, right? Or so with Macy's. Maybe the cost of their inventory, the quality is too high-end, right? That's why the cost of their inventory is just too high. You get it? Diba? Because the drop, ilan kanina ang Macy's? For current assets? 1.52. 1.52 is to 1, right? Then all of a sudden, they're left with barely 50 cents to $1. Right? So that tells you, something. And it raises a red flag. And the bottom line of ratios is that once red flags are raised like this, then it's time for the financial statement reader to do more in-depth research. Okay? Because do not think that this is the answer for everything that ratios are. It's just the starting point all the time so that you can know what questions to ask for one and what your starting point is. Okay? The next one is called, you remember this, AR, turnover. What is the concept of AR, turnover? Right, you turn over 1 year how much it is due and then collected, and then due and then collected. How many times? So a turnover, a common use of a turnover is in a restaurant. Remember, I told you guys before, right? So in a restaurant within the lunch period, which is approximately say 11 a.m. to about 2. How many times is one table turned over? Meaning, if it is, say, used by a set of customers at 11, if they are done by, say, 12-ish, will another set of customers occupy the same table and therefore during lunchtime have a 2 turnover for that table? That's a turnover in the industry, okay? So, you analyze accounts receivable as if in that fashion, where it is turned over a period of 1 year. The formula is you get net credit sales divided by the average of AR net. How do you do average AR? Divided by 2. And it says net. Net of what? Exactly. So, if, let's say, that this one is not presented net, do you still have to do something further? Yes. Pick up the line of what? ADA and subtract it. Okay, you know that, okay? That should come very elementary to you. Are we clear on that? Questions on that one? Correct? So, the alternative to this presentation, right now, the presentation that you see here with quality is like this. It says AR net. For how much again?
230,000.
230. That's it, not? Okay. Let's just say that you encounter another company and the balance sheet reads this way. AR 215. Allowance for doubtful accounts 20. Right? So, you will take both and subtract to get net. Okay? And since what we need in the formula is net, make sure that you just do not pick this up. And you make this step one more step further. You take that one step further. Okay? In netting AR. Clear? Clear? Okay. sometimes also, you'd have to assume if for the classroom setting, I will provide what net credit sales is. Okay? Because what do you think are there more than one kind of sales?
Yeah.
Yeah. One is net credit sales. If one side of total sales is net credit sales, what do you think is the other? Huh? If this one is saying just get credit sales, what are they saying? Is there another kind of sales? Huh? Is there another kind of sales? If one is termed credit sales. So this plus this is total. In this example, we were not provided this one. So this example, we just assume that this one is equal to this one. You get it? Yes? No questions? So, but in a problem that I give you, if let's say, what's the total net sales? Let's just say that total sales is this, no? And then on the side I tell you, oh, of which cash sales is 80%. How much is total credit sales?
30%.
Maybe 20. Sabi ko ba 80?
Hi,
Can you repeat?
Yun, I've lost niya. Okay. If I were to tell you that this is total sales, right? Of which 80% is cash. What can you deduce from it?
That 30% is
20% is credit sales, right? And if I am so predictable, I have to change my style, ano? Diba? You can already see the trade coming. So, knowing that this formula requires net credit sales, you have to figure it out. And this is actually, which one? Yeah, ask me, which one? Of which 80% is cash sales, which one is not understandable? I know my handwriting is not good. Which? Alright? Clear? So, we want this. If there is no information about such qualification, just pick up the whole net sales. Okay? So, in the absence of any detail like this, we will assume that the total sales is equal to credit sales. Net credit. Okay?
yes.
Be clear, huh?
Yes, yes.
Okay. So, divided by the average AR. What is, help me compute average AR. It is 230,
205.
230. So, average AR is 230 plus 180 divided, so these two divided by 2, and that is 2. Okay. Alright, we agree? So, it is just that, and therefore, we do this, and it is turned over 10.2 times in a year. Do you understand 10.2 times? Me, I don't. What's easier to understand? The 10.2 times? How do we convert it to something that is more intuitive?
AR is they need to hash them for 10.2
The number
times
of
fast.
days outstanding, right?
Number.
And what is that extra step that we need to do?
Very, very.
365 divided by 10.2. What is that? 30 something. So,
Cash is
what is the AR turnover that we got? AR turnover is
10.2.
10.2 times. I know. 10.2 times, right?
Yes, ma'am.
Okay. In order to convert this to number of days outstanding, AR days outstanding, how many days they are owed, right? We go 365 days in a year, right? Divided by 10.2. You still remember this? Diba? In your AR chapter, right? And you get, this now is expressed in days. 30. Okay. Lagay ko na rin para exact for all of us. 35.78 days. And this means that from the time that the sale is made, okay? This is the sale is made. Sales on account is made. All the way to the time that we collect the account, this amount of time is approximately 36 days it takes. Okay?
Yes, miss.
Is that good? Is that bad? I don't know. It depends on the company, and let's see how they fare. But before that, okay, let's be reminded. What is it? What is? We know quality is a department store, right? Do you know anything more about quality? How many branches? One. More or less where? Yeah, Middletown, USA. Okay, not the bustling cities of USA. So the quieter part of Middle America, right? One. Next, when you go to a department store, how do you buy? How do you transact? What happens?
You go to the cashier.
You pick up something, whether it is a piece of clothing or a piece of furniture or furnishing, and you go to the cashier, and then you pay. Do you pay in cash?
Sometimes.
Sometimes, right? You pay in cash
Or
credit
credit.
card, right? Especially if your parents, but they pay in credit card, right? Especially if it's a big ticket item, right? Do you ever say to the cashier, like in SM or in restaurants, I'll buy this on account, okay? I'll pay you 35 days from now. Have you ever done that? Do you think that if you go to Macy's, you can do that? Then why then is quality doing this? Collecting only after 36 days. Knowing who they are, where they are. Think. Connect the story for me.
So they can attract more customers.
No. How is this possible? If your own experience in a department store is that it is almost always cash. It is cash or credit. How then is quality able to do this? Connect the dots. This tries to channel your story, the storyteller in you. Miss Author.
Let's go, Celine.
Try to connect. What did I ask you? Where exactly is quality?
Middletown.
Hey,
So
connected.
it's far from the city.
Okay, so what?
You can't collect. You can't collect from the bank.
Answer.
It's not the same. Kasi if they use credit, I guess they only have a certain time per day where they can.
No, but why can't they behave like SM? Where it's either cash or credit card. Well, a credit
The
card
volume.
kasi.
You have to pay the missing credit card.
Yeah, but the credit card actually, you know, yeah, that gets paid to SM in about 3 days. It's not 35 days. Never 35 days of credit card.
Too much sugar.
Yes, Melissa.
What if they use check?
But if they use check, check clearing takes about 3 to 5 days, not 35 days.
Then they can always go to the bank kasi
And therefore, just because they don't, who doesn't go to the bank?
the owners of quality risk. So because it's pretty far from them,
And therefore,
they can collect cash.
do they collect from the bank?
No, it's when
When it's a
they
credit
use
card?
cards.
Oh, it
Ganun ba
gets
yun?
added to their account
Oh,
automatically. That's
Okay,
the nature of
they
credit
can-
card transaction. You know, we don't have time. I'll feed you now. Okay. When you're in the province, that's like Middletown, America, right?
Yeah.
And everybody knows everybody.
So,
They're probably relatives.
Oh, okay, so
Lista muna!
Sinabi ko na, ay sorry. Sorry, I was thinking that it's just like
Well, you know, if it's thinking, it's not counting.
oh, nga kasi.
Right? Look at the story and weave it in to the numbers. How nice what it is revealing. You get from your personal experience and what happens in a department store and try to transact in your head, right? And it doesn't make sense that 35 days is how they collect. But that's just how small
The department.
country stores like that behave. They know each other, right? Oh, just get the, I'll get this and charge it to my account. I'll pay you next month, more or less 30 days, right? Every month I pay. Give or take some allowance for 5 days. But that's about the cycle of it. But you see how revealing the numbers could be? Galing, no? Ano
Parang
yun?
yung mga sari-sari store dito.
Diba? Diba? Lista mo na
Sunod ba? Sa tubig
sa tubig.
Is it that's the case? Doesn't the waiter want the salary?
Well, they just have to have a buffer. Right?
How does that yung mga sa Aircel? So it's like,
Who?
The department store.
Which department store? Not all. SM, yes. SM, yes. But quality, I don't know.
There's one.
They're small. Maybe the suppliers only grant them 15 days of credit or 30 days of credit. So, I don't know. We will see. Alright? But how are they turning over compared to industry? They're turning over
Smaller.
less, no? And therefore more days. Correct? Because industry, do the math. How do you convert this to days? Jay, convert this to 2 days outstanding. Always be ready. You will never be ready for my class if you do not participate with a calculator, a notebook. You're not even taking down notes. Good luck to you guys. Convert this, Yeji, to number of days outstanding sa pato. Convert this to number of days outstanding, Austin. Guys, if you do not put in yourself, okay, with my lecture, good luck to you. I will see you this summer. 7 days, almost 8 days. So give or take, any glitches with a credit card company, because I told you, credit card companies 3. So, give or take some problems have every now and then, 8 days. Make sense?
Yeah.
Does this Does this validate the story that we have?
Yes.
About Macy's. Convert Hassel. What is this in days outstanding? 5 days, even shorter. Right? Versus 35 days. Diba? Parang it's just unfolding little by little. Galing, no? Just 2 numbers. Are you telling me that you're giving me a story based on numbers? You can read a story out of numbers? Is that the state that you are in now? You're nerds. Right? I mean, look at you. You can deduce a story from these numbers. I mean, of course, Aj has always been that way. But us, we're not very easily offended, diba?
It just said
We see the size of Chloe. And no, and can you just, guys, picture this little being just beating the crap out of it.
For tuloy ako.
I can so picture it. Oo. Isip ko, talagang pag ginanong-ganong ka na niyan, talagang...
Di ba, parang pimati yan sa lagi na mabigat eh.
Kung fu patin.
Okay, next one, inventory turnover. Okay, so, now that we have been reminded what turnover is all about in terms of AR, let's transfer that turnover knowledge into inventory. Ciara, so what does that mean? Okay, what is the action of turning over inventory? What happens when you sell it? You buy, you sell. You buy, you sell. That's one turn, right? How many times can you do that over a year? Right? You buy, you sell. So, the higher the number, is that a good sign?
Yeah.
What does that mean?
Once you can.
Yeah, it's just fast, right? Because the faster it is, the faster it becomes money. And that money, you have a markup that you keep, right? So just keep on turning, and each turn, you have something for you. You see, I mean, can you picture like the cycle?
Yeah.
Okay, so now, how do we compute turnover for inventory? We get COGS. We get COGS, which is this. And we get, which is in a balance sheet. And this one is just getting the 2 years of inventory divided by 2. In this case, they're turning it over 2 times. 2 times. Paano yun? Buy after 6 months, sell, and buy again after 6 months. 2 times. What say you?
Wait. So, sorry, I'm just gonna make sure. So, they buy inventory and after 6 months.
Okay, I just put 6 months because I know it is 2 times a year.
Oh, okay.
And I know that 6 months, 6 months make 1 year. Just one of the things that I learned, you know, when I was in college. Wait, Aj first.
If we wanted days, miss, yung 365 divided by 2.
Exactly. So, go convert this into days. Jasmine?
Every 100.
158.6.
So, approximately 160, yeah, 159 days, Raba. And how many is 6 months? 365 divided by 2. What is that?
100.
180 something. So, thereabouts. Close to 6 months because you got 159 days, right? Right?
So,
Yes.
every 159 days, they've already sold their inventory and
Everything.
they're going to buy now.
Okay, don't take it literally, okay? As if it is really, you know, you take and then it's gone. Oh my gosh.
No, but that's like the idea of
Yeah,
it.
Just the idea, just to
On
make
average,
it,
miss.
The
just to
starting
make it
period.
more understandable and relatable in our head.
The starting
But this is
period
just a
and number.
computation, right?
Like, for example, a car. If they buy a car every 6 months, they've already sold the car and thus they have to buy.
Exactly. So that car stays in the showroom for about 6 months before it gets sold and gets replaced by a new car that they just purchased as a replacement inventory and then sell it again. So that is the average. But don't take it literally, okay? Alright, we know better, right? Okay, alright. How are they doing compared to industry?
Slow.
So slow, right? This one is fast. Macy's is actually, well, a little below industry. So a lot of other competitors are doing even much better than Macy's, right? Because this is an average of all the competitors, right? So what does that mean? Eh, this is Middletown, eh? They, you know, their set of clientele is the same group of people over and over again, right? And they probably shop every 6 months, more or less, right? And whereas, you know, Macy's in bustling cities, you get all sorts of clientele, right? So that explains it. Or maybe they have slow-moving items. Could be something that they can look into. In fact, in big companies, they actually, really huge companies, there will be a dedicated inventory manager. And they, who's operations manager? Yung, bakit parang, inventory management that concerns calculations for ordering point, at which point should you order, talks, you know, has inventory in mind. That's one of the things for Ockman. Economic order quantity, etc. Those are quantitative stuff that I know that you get to study. Okay? But they have inventory managers to make sure that turnover is fast enough to be efficient and profitable. Okay? So, like you said, it is truly 159 days. Which is, that covers all of liquidity for our book. Any questions about liquidity? Looks like we can finish profitability, no? You still good? Anything you want to bring?
Tulog.
Ayun, rest pa din. Ano daw? Wala kayong sabi. Ano gagawin mo? Okay. So, after this, you can? Or, anong oras? Kung hindi ngayon? Tomorrow morning? Okay, you need to arrange with Miss Annette. Yun nga eh. I wanna finish ni. Para wala na tomorrow. What do you think? Okay, I don't like.
It's not the profitability.
Kasi yung profitability.
Hindi naman may nandyan. Hindi na pwede.
Hindi, siguro I'll just pick one from solvency.
Tapos tayo ngayon.
Huwag naman. When you've studied it anyway, in long-term liabilities, you've already done it, the debt to assets. That's
The
a
solvency. Where it's still, gonna be.
Ano? What is your question?
Anong profitability?
Hindi nga, we pick one solvency.
Ay, sige.
Sige na, na-inspire ako para wala na tayo bukas. Alright, profit margin, oh gosh, if you do not know this, please. Anytime there is margin, it means percentage, huh? Okay? So, gross profit margin. What does that mean? The percentage of gross profit.
Profit over net.
When you just say profit, you mean net income. Okay, the bottom line. In percentage, with the margin, if it is expressed with the margin. You get me?
The denominator, miss, will always be net sales ulit.
Okay? So, what do you think is the formula when filled in here? What is this? And then, this one. Okay? So, what is their profitability?
12.6%.
12.6. In fact, if you common size this one, remember, I don't know if you remember, but when we common size this, do you know the term? What do I mean when we common size this?
On vertical.
Okay. The equivalent of this one is also 12.6. Meaning that for every $100 of sale,
You have 12.6.
they are left with barely $13 of profit after everything has been paid. Yes?
Yeah.
So profitability is that. Profit margin is 12.6. How do they fare?
Good.
Okay. Because theirs is slow moving and theirs is the only one in Middle America. They can command higher prices. Because probably the next competitor is miles and miles away. What do you think about the bustling city? They are very competitive. They're probably side by side across the street from each other. Do you think that they're competing for lower prices so that they can get more customers? Yes, and therefore they have to sacrifice for profitability too. Yes, could be. And plus the fact that we realized also that for big department stores, overhead is big. SG&A, right?
Yeah.
And in a mom and pop or family run business, maybe like quality, several hats are worn by one person. And therefore, SG&A or overhead is lower. In fact, for department, for quality, iba $17. Macy's, $32. They pay for SG&A. Do you remember that?
Yeah.
I'm surprised I did remember. Despite, sa bao. Okay? You get it? Do you see the story? Boy, sure hope you're appreciating this because we are enjoying.
Me too.
Diba? How interesting. Of course, alam ko bola yun, diba? Tinay ko na lang ako, right? I know naman dati. I wasn't born yesterday. But anyway, kunyari na lang somebody is sharing the same enthusiasm.
It's fun.
It's fun.
Ganun naman. It's fun. Okay? Next one, asset turnover. Okay. The assets that they have, okay, are working for them. Okay? What do you mean? What predominantly, what is the biggest chunk aside from inventory included? PP&E. Maybe they're building where the department store is, diba? Any machinery that they have, probably, any equipment that they have, like vehicles or computer systems, etc., right? Cash registers and such. Okay, it is now, so I know assets do not turn over, but imagine this, it's like you're making your assets work for you, okay? And in the process, how efficient you are. How many times does it turn over based on sales? You know, meaning your set of assets, PP&E and all, because it's working hard, can generate this much of sales. So, you get this one by plugging in net sales again, divided by average total assets. Where did we get this? This plus this
Divided by 2.
So they have turned over their assets. They made their assets, all their assets, work for them just one time, and then that's the equivalent of their sales. So that the higher the number is, the more efficient your assets are giving you power to generate sales. Okay, so this is just a just a very theoretical way of thinking things. Okay, it's not do not think it is physical and literal. Okay, so how are they faring? Oh, okay, not bad. Look, not very far away, just there. So yung ano nila, that like, real estate, etc. Yun lang talaga yung kaya. Because maybe land and building is actually expensive.
So, kaya kung factory, mataas-taas yan.
It's possible. Think about Meralco. What do you think? Baka ang liit yan. Baka less than one time yan. Why? What does Meralco have to buy?
Electricity. Power plants.
The power plants, do you think that's heavy on equipment? Do you think that is something that we can buy from Ace Hardware? The equipment that Meralco has? Oh no, right? This is specially built for them, right? These power plants, right? And this costs billions or tens of millions or hundreds of millions, right? And therefore, before they can turn it over really, there's a lot of years of sales, not just one. So, the heavier you are in PP&E, the smaller this will be. Okay?
Means that you're heavily invested
You're heavily in capital
in equipment.
equipment. Okay? That's what it is. But let's just say, let's say you're a software company where most of your assets are your people really coding and creating apps and software programs. You have your PP&E basically are your computers, and they're cheap compared to the power plants, right? And then your sales is so high because it's online, you can purchase it all over, it's global, and then your asset base is so small. So this one is so high. So it depends on the industry that you are in. So something is normal like this to such an industry, but then you cannot base this number on another kind of industry, kinda like a software company, diba? Because this is nothing. They probably spit on this number in the software companies, right? Like that. Okay. And next one, ano tayo kanina? Turnover. So the return on assets is the net income divided by total assets. Hindi ba yan ang ginawa natin? Ano ba kanina?
Asset turnover.
Net sales. Ito net income. Okay. Based on what was left from our operations, how many have we? How much was the return of our assets? This is kind of like ROI, right? Remember? We discussed this, remember? So how many years is 15 for? 15 for? How many years is 15.4? RC! 15 years, no? 15 years, right? How do you compute per years? 100 divided by 15.4.
Sorry, miss.
If somebody told you that your ROI for your business is 20%, how many years is that before you can recoup
5. 5 years.
5 years. So, if you, look, write this down. If you invested 1 million and your return is 20%, how much do you expect a year?
500,000.
No,
I sorry,
200.
200,000 a year. Sabi ko, alam mo, carry na nila to, hindi ko nasusulat kasi pagod na ako. Pero hindi pala, kailangan ako sulat, guys. Si Hernie kasi eh. I know, di ba? Hindi ko sila naawa sa akin. Di ba?
Sorry.
If your investment is 1 million pesos, and you're saying, oh, my ROI or return on assets sometimes, you know, not all, it's 20%. This is the same concept kasi. Okay? How much do you plan to earn if this is true? How much?
Okay, it's recording.
Ah, So how much net income per year? 200,000. Right? Kasi 20%. Right? So this is year 1. Year 2, 200. Year 3, 4. On the 5th year, 200. Have you recouped your investment
Yes.
at 200 for 5 years? Yes! Because 200,000 times 5 years is? It's the same thing. Okay? But it's just, you know, rounded off. You get it?
Yes, miss. Yes.
Right. Alright. Okay, aba, look. Look. It takes longer. It takes longer for industry and Macy's to recoup. How many years do they have to recoup? Aaron, 11 years. Is real estate more expensive in the city? Is real estate part of PP&E? Of a department store? Oh, they have to have land?
Yes.
Oh, for what?
Rent or
Warehouse. And how about the store itself?
Yeah,
Where will it sit? Right? On air? Right? You see how, well, common sense, business sense, everything tied in with the number sense and accounting sense. It's just putting things in perspective and putting the right pieces of the puzzle just all together, forming a real story and picture, right? I hope you're kind of doing that, huh?
Miss,
Because that is objective.
so basically, Miss, the return on assets is like the parang ROI of
Parang ganun.
when you can get back the
The asset.
yung capital expenditure mo, the asset. and
Exactly.
yung-
Exactly. Because when you have an investment, you know, when you have seed money for your investment, all of that more or less, give or take, no, but not all the time. It's bought predominantly on bought
Yeah.
for assets, di ba? So yun yung nire-recover mo. That's
okay.
what you're trying to recoup your investment in your assets, right? You get me? Okay. Next one. Ito, alam niyo na to, right?
Yeah.
Return on, so it's the same concept. I will not, so the stockholders can expect almost, a little over 29% of return in their investment for stockholders, okay? Which is still good compared. And never mind that. And EPS, right? Remember EPS.
Yes,
I will
miss.
not touch on
Yes, miss.
EPS no more. Okay?
Nemo.
No more. Alright.
Okay.
Huwag na to. Skip!
Skip price earning ratio.
PE ratio.
Wait.
Well, ang dali lang eh. Kukunin nyo na yung market price.
Skip.
And then ito, kukunin nyo lang doon sa EPS kanina. That's it.
Market
Well,
price.
you take it in finance.
Price of market.
Yung market ngayon, you know, you go to the stock exchange, that is what it is trading as.
Earnings per share.
PE ratio. What this means
Kasi di marinig.
is kinda like parang years din. So, you know, this is like, huwag na, skip na to.
Skip.
Finance nyo na to. Ratio. Payout ratio. Huwag na rin to
Skip payout
I
ratio.
don't like this na. Okay, so let's see. Ha? Gusto mo siya?
No one's asking.
When you keep on asking, parang na-inspire ako eh. Ay! Look at this! Solvency only has 2!
Yes. Yes.
And we have already discussed these.
Yeah. That was Skip din, miss.
Okay, since we have discussed this, let me just tell you a story. Yesterday, I went on a, leadership show, right? Club the leadership program, right? With the freshmen, no? And then there's this transferee who approached me and said, Miss, I need to talk to you po because I want my accounting subjects credited. From where? From UANP. Okay, that's nice. Please show me na lang your syllabus, show me your transcript for your grade, and then I need to interview you because I need to know which accounting ba, everything, accounting 1, accounting 2, managerial accounting 2. All daw mapakredit na. Okay. So sabi ko, okay, let me talk to you first and you kind of test your know-how, no? Guys, right? Don't you think so?
Yes.
Before I credit
Yeah.
all 3,
Yes.
right? So I guess I like, Miss Pan yun, how does that go? Well, what do you know about accounting?